Marco and Herman for the invitation to chair this panel. It is a privilege to be here this morning. My name is Sahar Shamsi. I am a partner at Oxera Consulting, and I lead our work in climate economics. Over the course of the next hour and 15 minutes, we will have two presentations and a panel discussion. I would like to take a few minutes to introduce our topic, and then I will introduce our speakers before asking them to give the first presentation. So, our topic, the mitigation of climate risk by financial markets and by corporates is a big issue. It's multifaceted, it's emotive, it has existential importance. So the challenge facing all of us and our speakers in the real world is how to take this huge issue and make it tangible and tractable. What are the actions that we take and that we can take so that the efforts of all of us as policymakers, as investors, as consumers, as corporates, all of these roles and activities add up to the delivery of the Paris Agreement? After all, as Colin and Marco have introduced, with this theme of the day of responsible capitalism, we are in a world where the study of economics and the function of markets itself is to allocate capital efficiently, in theory. So in this age, that must include an efficient movement of capital towards the green economy. So that introduces the topic of this session and what our excellent speakers are going to discuss: how climate risk mitigation is being factored into market efficiency and into sustainable business models. Our speakers are Professor Patrick Bolton. He is Professor of Finance and Economics at Imperial College London. He has written numerous papers in the sphere of risk management and climate change, including on how investors are already requiring higher returns to invest in higher carbon emitters. Today, he will speak about how a portfolio could be developed that is aligned with the delivery of net zero goals. Hans de Cuyper is CEO of Ageas, a multinational insurance company based in Brussels, where he has been for nearly 20 years. He is now leading Ageas through a new chapter in its history, one where it places sustainability at the heart of the business. He will speak about Ageas' net zero journey as an investor and as an insurance product provider. In terms of allocating our time for this session, first, Patrick will give a presentation, followed by a presentation from Hans, and we will aim to have about half an hour for a panel discussion. For this panel discussion, I wanted to let you know that you can submit questions for the speakers at any time using slido.com. So if you go to slido.com and you use hashtag ECGI Summit, you can enter your questions, and that is for both the audience that is listening digitally as well as the audience that is in the room. But around the room and on Slido, we will take as many questions as we can during the panel discussion. So, without further ado, Patrick, could I please ask you to give your presentation?
Thank you. Thank you for this introduction. Thank you, Marco, for inviting me to this inaugural conference, which were started in a very amazing way, I have to say. The first session really framed the issues and their importance very clearly. So let me jump into my presentation on climate change and investors, the risk management perspective. What I will do first is give you a little bit of context, and then I will jump into a concrete solution. The context is that we are in a world now where we are suffering increasingly from a carbon externality which is caused by a market failure. Nick Stern, let me quote from him. In 2008, he wrote, "Greenhouse gas emissions are externalities and represent the biggest market failure the world has seen." Yet, companies, as we've already heard, they've been told, Milton Friedman is quoted here, but many more people have said, companies should focus on making money. They should not worry about the impact of their activities on the environment and society. That's something for governments to worry about, right? And this is very much the framing we live with today. Now, what is left unstated is that we're also letting companies lobby against regulations. In particular, the abolition of the EPA, which was proposed here. You have a list of names, and then it's a much longer list. So you can't have it both ways. The reason why we're here today and why we are launching this initiative, the Responsible Capitalism, is because governments have failed to act on climate change. That's why we have the rise of ESG. This is a great picture, maybe somewhat pessimistic, but there is a truth in it. There have been efforts all along, starting in 1988, by governments globally to try and control carbon emissions. And the jury is still out whether we're going around in circles. Because, here's just another picture similar to one that Marco showed us in his presentation. Carbon emissions keep rising. The only time when we had a decline in carbon emissions was in 2020 because of COVID. But post-COVID world we're back full steam, sharpest increase in emissions in 2021. And that's really what explains the rise of ESG. ESG is a phenomenal development. 20 years ago, it was a niche in the financial market, and it's grown to, according to Mark Carney, a 130 trillion asset under management size, about 40% of global financial assets, under the Glasgow Financial Alliance for Net Zero, or GFANZ. That's fantastic, yet there's already been a backlash. Now we're talking about woke capitalism, and there are increasing concerns with greenwashing, over greenwashing. One notorious example among many, but just one I've flagged here on the slide, is DWS, which was caught red-handed engaging in fairly large greenwashing. Why do we have this backlash? Well, partly, there are big stakes here, the politics involved, but partly also the ESG movement has been very framed in a very confusing way. And that's what I want to point out first before I turn to what I think is perhaps a more robust framing for what ESG is trying to do. So point number one, in terms of confusing aspirations of ESG, investors and financial markets cannot substitute for government. You hear that a lot. Investors will come in, they will be responsible, they will be actors of change, and suggestion is they can do the job of the government. That's very risky. They can't do the job of government. Investors can complement government actions. They can avoid getting in the way of public policies, support public policy initiatives, but they can't substitute for government. And if asset managers were to attempt to replace government, they would quickly face pushback and backlash, and that's what we've seen in the last few years, in the US in particular, with all the state initiatives targeting BlackRock and woke capitalism in general. Another confusing framing of ESG. ESG investors cannot do well by doing good all the time. So often we hear that, even today, that if you are an ESG investor, you will come ahead financially. But that's the wrong premise. That can't be true, at least at scale, because it involves a mispricing of assets on a systematic scale in financial markets, which we know is not realistic. It's a form of, it's built on a form of stock market short-termism, which may work in the early years when people weren't really paying attention. But when you have a mature market with 40% of financial assets pursuing some kind of ESG strategy, it's no longer possible for ESG strategies to generate alpha. And I think the quicker we move away from that, the healthier it will be for the ESG investment movement. And point number 3, engagement is not enough. Most institutional investors, here a quote from Cuyper and Calsters, firmly believe that engagement is the first call of action. And until recently, this has also been the stated policy perspective of the Harvard Endowment, University Endowment, saying that maintaining a strong presumption against divesting investment assets, the endowment is a resource, not an instrument to impel social or political change. Yeah, I mean, engagement, the more we can have, engagement, the better. But if you take a broad brush view on what's been done so far, there's little evidence that shareholder engagement has had a significant impact in curbing corporate carbon emissions, and that's the problem. So what do we do? What do we come away with? This is what I want to propose, is that climate finance and ESG, from a point of view of investor, it's a risk management problem. You want to think of it as a risk management problem. And here I have a really excellent quote from Bob Litterman, who was the chief risk officer of Goldman Sachs until the financial crisis. And he wrote in 2010, let me read it to you. Not pricing risk appropriately leads to disasters. Start by thinking about what would be the appropriate price for carbon emissions today. What should the price reflect? The price should reflect the risk created by carbon emissions, clearly, yet the situation we have today with respect to carbon emissions is that not only are emissions currently not reflecting a premium, they are not even reflecting the expected discounted damages. How serious is it when a systematic risk is not priced appropriately? Recall what caused the financial crisis was also a systematic risk that wasn't being priced. Not pricing systematic risk leads to too much risk being taken, and such a situation will eventually lead to a high probability of a global catastrophe. 2010, it's pretty remarkable. And I couldn't have found better words. That's why I read you this quote. So now let me turn to what risk management could mean, and propose something very concrete about net zero portfolio alignment. This is based on a paper, recent paper with my co-author, Marcin Kakpersik and Frederick Samama. Our perspective is the perspective of a well-diversified, large investor who takes the world as given and who aims to reduce the carbon, the portfolio carbon footprint to net zero by 2050. How should that investor, such a large investor, do this? And when I say large investor, think the Swiss National Bank or NBIM. It's sort of designed for a very large institutional investor. So the question we ask is, if companies in the portfolio are not net zero aligned, they're not on a net zero pathway, how will the portfolio have to be adjusted to remain net zero aligned? And again, this is the perspective from a well-diversified investor, and the technical jargon here is we're looking at net zero portfolio alignment while minimizing tracking error. And so what does it mean, first of all, to be net zero aligned? Here we build on something Marco already mentioned in his presentation, the idea of a carbon budget. And we're told that the world has a limited carbon budget if we want to avoid warming beyond 1.5 degrees centigrade. And that budget was around 300 gigatons of CO2 in 2020. As we speak, it's closer to 260 or even 240 gigatons of CO2. And so the idea that underlies our proposal is that the carbon footprint of the portfolio shrinks along with the planet's shrinking carbon budget. And the portfolio footprint is defined as the emissions of constituent companies multiplied by the weights of these companies in the portfolio. And the portfolio is constructed dynamically so that the carbon footprint, as defined here, shrinks at the rate that is aligned with net zero. The main simulation we did has a reduction trajectory of 25% reduction in the carbon footprint immediately, followed by an 8% reduction until 2050. And again, to minimize tracking error or to keep the portfolio well diversified, we have sector allocation that don't deviate too much from the benchmark, from the market benchmark, plus 2 or minus 2%. With this constraint, the exercise is to rebalance the stocks that remain in the portfolio. The tracking error is calculated using a standard factor risk model, the BARA1 risk model, and our baseline assumption is that constituent companies will not reduce their emissions. You might say, well, maybe they will. They're saying they want to reduce their emissions. The evidence is, if anything, that they continue to increase their emissions. That's the reality. We've done a simulation on what's the most likely trajectory forward in the next few years for carbon emissions of companies, and it's that it goes up rather than goes down. We're taking as a working hypothesis that they remain constant. And so what do you do as an investor if all your constituent stocks continue to emit and you have a net zero target? That's simple. The only thing you can do is to shed companies that emit too much and hope you can get somewhere close to net zero. And so our exercise, the main takeaway is that you can be net zero aligned for a portfolio as large as 1 trillion euros. And you can, and while doing being net zero aligned, you're still not suffering too much in terms of under diversification. The tracking error with respect to the Europe MSCI is initially very low, 0.08% in 2021, and of course closer to 2050 it's a little higher, but it's still manageable, 1.9%. And we've done this for other market indices besides MSCI Europe. So here's a picture of how this is done. You can see the budget shrinking as I've described on the left picture, and you can see the tracking error rising as we do this. But the key point is that what's called the active risk generated from decarbonizing the market index remains low, and so it's something that doesn't involve a high diversification cost. In addition, the way this portfolio is constructed dynamically to remain net zero aligned creates a form of engagement with the constituent stocks, because you can tell the constituent stocks in advance that if they don't reduce their emissions, they will drop out of the index. And companies never like to drop out of an index. And here you see a path for energy companies of how they exit the MSCI Europe index over time. Another important point, once you've said it, is obvious, but it's something that hasn't yet been built into at least some of the regulations that have been put in place in Europe, and that is that time is a risk factor here. The longer you wait in decarbonizing, the faster you will have to decarbonize later on. And in our framing, you can if you start in 2022, you have to decarbonize at a rate of 10%. If you wait a few more years, 18%, and then by the end of this decade, you've already missed the 1.5 degree target. Now, Standard & Poor's have just launched a battery of indices that are built on this idea. So this is a solution that is already available to investors. Institutional investors who are not quite sure what it means to be net zero aligned, what to do, they can just turn to Standard & Poor's and implement this solution. Okay, so they've introduced a battery of indices, the S&P Net Zero 2050 Carbon Budget Indices, and they do in more or less what I've described. They reduce carbon emissions from the portfolio 25% initially, and then they keep on doing this on a 10% yearly emission reduction basis. Somehow the slide didn't quite I can't read you the quote from Richard Mattison, the president of S&P Global. It's sort of cut off here, but he's basically saying what I just said that this is a simple, transparent, and scalable tool that is readily available for investors. And maybe if I can turn to the next slide. Someone is controlling my slide somewhere. Oh, okay. Yeah, there you go. You have the quote. So let me read it. It is essential that investors have access to simple, transparent, and scalable tools to support their decision making, and we are proud to be launching the new series of indices to support investors in navigating the transition to a sustainable future. And last point about this new battery of indices is that what I want to point out is that these indices are rebalanced annually, and they are building in the most up-to-date data on carbon emissions. And the other interesting aspect is that they are marketed as vintages, index vintages. So you have the 2020 vintage, 2021, 2022, and so on. What's the point about vintages? It's the time is a risk factor, that you have to reevaluate the rate at which you decarbonize in future years. So that is built in the whole methodology. So to conclude, climate finance is a risk management problem, and from the point of view of an investor, the greater the deviation of the portfolio carbon footprint from a net zero footprint, the greater the risk this investor faces, transition risk exposure of the portfolio. And so, bottom line, good risk management means aligning portfolios with net zero goals.
Thank you, Patrick, for that excellent presentation. What I like about it is the pragmatism and the fact that we're using tools and data that's already available. So this idea of assigning weights to constituent companies based on their emissions for deciding which assets are included in your portfolios, this goes beyond ESG investment mandates to looking at a very practical policy prescription that enables us to get to the Paris Agreement 1.5-degree target. So in a way, it is that alignment of incentives of the companies and the corporate agenda with the investor and policy prescription, which in a way you are looking to the market to create a solution for. Now, I want to stick with the theme of the market and the delivery by companies. So on that sustainable business model of corporates, can I now invite Hans to give your presentation on the net zero journey that Ageas is going on?
Okay, dear Professor, honorable guests, ladies and gentlemen, I'm truly honored to welcome you to what you could call my hometown, Brussels today, and to discuss with you a little bit a very important topic that is close to all our hearts. In the next 10 minutes, I will share with you the Ageas sustainability story that we have developed under our new strategy, Impact 24, but also some personal views, I would say more some implementation attention points on the views that have been shared by Professor Bolton just now. Well, as a mathematician, I've always preferred, of course, numbers over words. And when it comes to climate change, and while actions today speak louder than words, I found, and you agree with me, that it's the numbers that truly make us nervous right now. At Ageas, we said we put sustainability at the heart of everything we do. And that is not just to save the planet, but it is part of a strategy for sustained long-term growth and performance. We are convinced that an integrated and balanced stakeholder management will be key for our business, and we believe actually for all businesses to stay future-proof. And as managers, it's our duty to think forward, to act as a responsible and future-positive company. And in life insurance, thinking forward, that means a long time. We look often more than 40 years ahead of us. We put sustainability consideration at the heart of our decision-making to innovate, to understand risk, to drive growth, and to build a more inclusive and a more greener future. And we have centered our sustainability story about 4 axes, and I'm not going to elaborate too much on the first 2 because the topic of today is more the latter 2. For our people, we built a great place to grow because we know that after COVID, a great place to work is not good enough anymore. You need a great place to grow. And for our planet, our impact directly, our CO2 footprint is limited. We talk about approximately 20,000 tons a year, but we have already received the CO2 neutral label for all our controlled businesses around the world today. So we have been thinking in the design of Impact 24, what can we do more? How can we leverage our view And then we said, look, we have 40,000 employees, I spoke about that already. But we also have 45 million customers, and we have a 100 billion euro balance sheet to invest. And that's the two other blocks. First of all, for our products. Well, we provide solutions for the dramatic effect of climate change. Covers for flood, for drought, for hurricanes, crop insurance, and so on. But it only mitigates the effect of climate change. It does not solve the root cause of CO2 emissions. And in the end, what we see today is the increasing cost of reinsurance and insurance will finally be borne by our citizens. So what we actually do as an insurer is we diversify the social cost of carbon over the society. And we said, it's great, but it's not enough. And therefore at Ageas, we have decided to go further. And we have said that within our product and service offering, we want to incentivize our customers to make a choice that offers them an active contribution to the ESG transition. And I give you a few examples. We have life insurance products where our clients invest in, and for all of them, we have the sustainable asset versions which have today the highest sustainability label available. In Malaysia, for instance, we have already a motor insurance product promoting less driving and including the use of alternative mobility solutions. In the UK today, if a customer chooses Ageas, we will promote recycle parts for repair instead of new ones to be more green when we repair your car. And today, in Belgium, in the area of S, today we accompany already more than 3,000 burnout reintegration trajectories for our employee benefits corporate clients' employees. And then let's look at our investments. We have a 100 billion euro balance sheet. And of course, in pension business, a balance sheet with a long-term and responsible approach on how we invest, contributing to the solutions for climate, but also inclusion as well as corporate governance. But first of all, we have committed that by 2024, 10% of this balance sheet, and we are almost there to be honest, is directly invested in initiatives that make a positive contribution to the transition. And I talk about investments in windmills, solar panels, social housing, public transport, and so on. That will very soon be 10% of our balance sheet. But we have included now ESG scoring in almost 100% of our new investment decisions. And we are committed to a net zero emission ambition of the European Green Deal by 2050, and I will come back on Professor Bolton's graph in a minute. And of course, like all of us do, we exclude brown activities, like coal, shale gas, Arctic drilling. And of course, we favor those green opportunities with almost 10 billion. But actually, in between, there are 50 shades of grey. And it is in this area where Ageas wants to stimulate and wants to accelerate the transition. Because sustainability is not about perfection. Sustainability is about making progress. And it is not about today walking away from companies that are transitioning to where the world wants them to be. No, it's about supporting and motivating them in that transition and making in this respect the right choices. But transitioning is also very important from a risk management perspective of an insurance company. Let's not forget that all our investments, most of our investments, are pension liabilities of our customers. And that means that by far the biggest block of those investments are buy and hold fixed income instruments, matching pension liabilities 20, 30, 40 years ahead. So if we do today a forced sale of a grey bond, that will be great to contribute to the E. But it will lower the pension returns for our clients and our citizens, and it will negatively impact the S. So transition is key. Let me close now with some business views on the statements made by Professor Bolton. And Professor, the good news is we agree with all your statements. I just would like to add a few implementation concerns that we have and that we hope this organization and this new work stream and this summit can help to keep the debate going. First one, we agree with you. The financial sector cannot replace the government. Both have their role to play. To define an ambition, to make a binding commitment, but also to structure the delivery. Too easily, the last 10 years, the financial industry has been forced to organize responsible finance because global standards and regulations fail. I think about our role in anti-money laundering, data protection, avoiding tax havens. Carbon reduction should not go the same way. Both have to play their role. And of course, with the very strong compliance focus that we are having, banks as insurance, after the financial crisis of 2008, we will make it happen. But responsible finance without a legal framework is not cost efficient, and I'm afraid in many cases it might not be effective as well. Second, supranational regulation is needed. CO2 is not a national issue. It's a global issue. But financial markets also operate internationally. And supply and demand follows the law of least resistance. That means for us, if we achieve a net zero statistics for AG, our company in Belgium, that will not reduce CO2 in the world. If funding can easily be found in another continent or maybe in the private equity industry. So the major attention I see is for supranational institutions to provide a framework of global standards of implementation to level the playing field for companies and to drive demand in the right direction. We also need, and that's a topic very actual in the US today, we also need a safe environment for listed financial institutions and other corporations to communicate on their ESG commitments and ambitions. Because without a stable ESG framework to anchor our story, the risk of activism for us as a listed company is real. The blame of greenwashing is pertinent, and green hushing becomes the only way for us to avoid scrutiny. And that would lead to a missed opportunity for the best of intentions that I see today many companies in the corporate world have. ESG ratings are a strong call for actions, and they have their role to play. But as of today, they are still too immature to serve as a reference. Standardization and stabilization in scope and taxonomy is needed. Market consolidation here would be welcome to develop in the end a reference independent ESG scoring. And active engagement by agency ratings with the corporate world, like we know it already for many years in the credit ratings, is absolutely urgent and should build better alignment. The economics of CO2 emission reduction should also be complemented with the economics, and I think the improving economics, of CO2 capture and removal from the atmosphere. Because combining both will make the transition more, I would say, digestible for societies and economies. There is a tipping point somewhere, and the tipping point continuously improves due to the development of science and technology, but there is a tipping point where $100 to be invested in carbon removal technology could be more productive than $100 invested in reducing CO2 emissions. And we need to work on both sides. Shareholders and financial analysts and investors are also still struggling to appreciate ESG in their valuation models. That's what the professor have just called the stock market short-termism. A universal metrics here for the social cost of carbon to be included in their models might help. And then I conclude with the net zero alignment. We fully subscribe to this as Ageas, and I can fully agree with the professor that the time is now. 2050 is too far away. 2020s must be the decade when governments and businesses act on what we all now see as the climate emergency. And during this summer, a team of experts at Ageas has worked for 3 months to gather data on the absolute emissions from our 100 billion investment portfolio. And not only did we calculate that for our equities, but we did it for our bond portfolio as well as for our real estate business. And I can tell you now that we aspire and we can achieve a reduction of CO2 emission in our investment portfolio with 50% by 2030. Governments made some noise about the importance of moving to a net zero future to limit warming. But however, unfortunately, as it has been widely reported, the national pledges made are likely to fail far short of meeting the goals of the Paris Agreement. The problem is not one of ambition. It's one of making binding commitments, delivering on investment promises, and laying out the detailed roadmaps. And at Ageas, we frame climate change from a risk to an opportunity. Responsible finance decides where investments will be made in the future. Sustainability and profitability, we are convinced, are no longer mutually exclusive. Non-sustainable companies will have a hard time landing on a long-term growth strategy unless they are willing to take a very high risk. And in efficient financial markets, this means they will, and Professor Bolton has proven that already, they will have to pay what I call an unethical premium to their shareholders or a higher yield to their investors. Ladies and gentlemen, every person in this room feels the urgency to act. But the transition takes time and requires structure. It is crucial to accept that the road to 2050 is not a sprint, but it is also not a marathon. It's a relay where politicians and managers together will deliver results and pass the baton to the next generation. But now that I heard the professor, I maybe change relay to vintage because that sounds a lot more fancy than running. But the story is the same, and only this way we can stay on the curve of Professor Bolton. We must come together and learn from each other during gatherings like this summit, which we are happy to support. And ultimately, if we all take our responsibility and leverage on the role that is granted to us, we create a rippling effect today, growing into a positive wave tomorrow, and ending in a net zero planet by 2050. Thank you.
Thank you, Hans. So, a huge amount of, I think, congruence and commonality between what Patrick has said and what you have said. So in particular, I was struck by your unethical premium being very similar to your carbon premium. The aspirations are the same. You're harboring on the role of, or focusing on the role of incentives in driving this and the market-led transition or investor-led transition, but with the overarching theme that you both have of it cannot be corporates going it alone. corporates with a sustainable business model have a role to play, and investors with a focus have a role to play, but governments need to play a facilitating role. And you said this is at the supranational level. But I think the thing where you have focused, and where I think perhaps, Patrick, maybe we come back to this in questions, where you have focused less, is that idea of frictions, that in moving from this grey and brown fossil-fueled economy to a green economy, there are winners and losers, and this idea of, in a way, maintaining the legitimacy of the movement towards a green economy rests on there being an idea of a just transition and gradual easing of capital. Now, I think actually you are both thinking of similar things, because your model of moving with dynamic weights is aligned, but perhaps that's something that we can focus more on as well. So we're doing very well for time. We have exactly half an hour at this point for the panel discussion. I think I'll begin with a couple of questions to each of you. I see that questions are already coming in on Slido. I would like anybody else, both in terms of the room, I'll be asking you for questions in the room, but equally, if you feel more comfortable, and obviously on the digital, the virtual audience, please carry on with questions on Slido, and we'll take as many as we can. But to begin with the questions, the one that I had actually for you, Patrick, in the first instance was that both you and Hans mentioned this need for policy and government interventions to play a role. And I was wondering if you could expand on, pick your top 1 or 2 priorities. If you had some asks, what would they be?
Great, thank you. Yeah, I mean, this is you're putting me on the spot, and rightly so. So, to answer your question, let me take a step back and say something about what Paris achieved, the achievements of the Paris Agreement. The achievement has been the introduction of this notion of net zero targets. Global net zero target by a certain date. Some countries are more ambitious than others, typically 2050. Companies are also setting net zero targets. Asset owners, asset managers are now jumping in. So, why do I mention net zero? Because first, it's an opportunity to frame policy around that target, and it's also a way of simplifying an extremely challenging and complex policy question. And so what I would put forward as almost a priority at this point, given this context in terms of policy, is to move from a 2050 target to a year-by-year pathway to the target, and to put interim targets so that we can actually hold everyone accountable as we progress to net zero. If we can do that, and as comprehensively as possible, we're really, I think, leveraging this policy approach. And to the point, one of the key points that Hans made in his presentation, when he mentioned, 100 euros to reduce 1 ton of carbon, or 100 euros to invest in carbon credits, essentially. I think this is how I understood your question. That's the direction in which we need to go. We need to frame the targets in terms of net reductions, not gross reductions. The difference being that if you can't do it yourself because it's too costly or too difficult, you have others do it for you by buying carbon credits. And along with the net zero goals, with articulated as a year-by-year target reduction, we want to scale up the carbon offset market, carbon credit market, to make it easier for companies to meet these targets and to make it a much more comprehensive target. That would be, maybe I was a little bit too long-winded, but that's how I would answer your question.
I think we'll return to that one with one of the Slido questions. But before we do that, I wanted to pick up on one of the themes which I thought was less explored in your presentation, Hans, which was that you have a dual role as Ageas. You are both a big institutional investor as well as an innovator in terms of products for insurance, because ultimately, if climate is a risk management, risk mitigation problem, as Patrick is saying, it's about insurance also helping to play that role. So can you tell us a bit more about that latter role, about how you see innovation in insurance product provision around climate?
Yeah. Well, there are multiple areas. The first one is, and very often insurance always have been looking at risks to exclude from cover. For instance, natural disasters, we have only learned by getting the statistics in how we can include that in the pricing and the underwriting. And I think we are a lot more now inclusive in providing solution than exclusive, avoiding cover, because of the immeasurable financial impact that it might have. And we have made significant progress there, but as I said, that's great to bear the impact of the whole CO2 issue, but it's not going to solve the issue. And so what we have said is, how can we make a more active contribution? Because when we came with the sustainability story, almost all our employees say, but look, the business we are in is sustainable. We give pensions to our citizens, we protect them for accidents, we protect their houses. All this is very sustainable. I said, yes, that's true. But we can also stimulate them to make an active contribution. For instance, what we are looking at now, can we not combine the mortgage by the bank with a home insurance, which gives you an initial incentive if you decide to make your home more energy efficient. So give them benefits, yeah, so that at the end of the day, our 45 million customers have the same mindset when they choose for us as we have. So that's how we see our leveraging role. And we have already many, many ideas, but we will run a hackathon with all our product managers around the world in the month of February. We have done a zero measurement, and we have said actually today 16% of our products have already an active contribution for our clients. If we take a light definition, which I rejected from the table and I said it's too light, we would be at 33. And we said, look, I reject the 33, but we organize a hackathon because I'm sure that if we strengthen the story of those 33 and we give more incentives, we can bring them to the 16. And that's why we have said by 2024 we will have 25%. And I think it can give a great dynamism, and I hope at the end of the day also a lot more positive view on the insurance industry, because you know insurance industry very often has some struggles with their corporate image. And I think that can also help our role, further improve our role in society.
Thank you. Okay, let's take some questions around the room in the first instance. Please wait for the roving microphone. I'm overwhelmed by, I think this gentleman in the middle was first. So if you could please say your name in the beginning and your affiliation, that would help.
Yes, Tom Gosling, London Business School. I've got a question for Patrick, and I mean, Patrick, I accept the point that engagement hasn't had a kind of a great track record in dramatically reducing emissions, but it's also true to say that nor has divestment, and that, you know, as Philip's work, Kruger's work has shown, you know, institutional portfolios have been decarbonising over the last period of time, and emissions have carried on going up. So, I mean, I guess, you know, the point is it doesn't seem to me that your approach is very likely to change anything in the real world, because it's just a progressive divestment strategy. So isn't there a risk that it's just a way that people can feel better about themselves without really changing anything?
Okay, Tom, this is a great question. And you're right, the divestment, you know, has been often framed as the alternative to engagement, and we could, as you did, apply the same criticism to divestment as to engagement. My point is different. My point is, let's not look at divestment in terms of does it achieve significant reductions. Let's look at divestment in terms of does it reduce our risk exposure. This is a purely, if you want, risk-return motivated perspective for investors. They take into account the large and increasing transition risk they face, and what we have proposed is to say, faced with that risk, you have a way of managing it in your favor by reducing your exposure to that risk over time, so as to be net zero aligned, while remaining well diversified. That's the calculus. I have not said anything about, oh, is this strategy going to impact society? Is it going to change the world? Because framing ESG investment this way, I mean, it's great, it's laudable, but it's risky. It's risky because it politicizes ESG, and it may undermine ESG by, very easy criticism. You're saying you're doing all these wonderful, that's the greenwashing critique. You're doing all these wonderful things, but where's the evidence that you've changed anything? I think that's the delicate spot we're in today with ESG. And that's why framing it as risk management is a much safer, much more solidly grounded way of thinking about ESG.
Yeah, and I can add that typically for an insurance company, we have these 30, 40 years investments, for asset liability matching. But the enemy of the asset liability matching is the credit risk. And so if those companies would not go on the road of ESG transition, and they might get even credit issues, that they will not find renewal of their funding, or that their valuation on the stock market will drop, we will have another issue, because then I come back to this matching of the pension liabilities. On that area, by the way, and I see it in more than one country, there is an active engagement with the national banks, saying at which moment in time the ESG movement becomes a credit risk on your investment portfolio. And what are you going to do to avoid it? And so what we, and Wim, our chief investment officer, is in the room. So we go in an active engagement with these companies to say, if you want to stay in our portfolio for the lifetime of the bond, then you will have to go on the path of the CO2 reduction. Because otherwise, not only because of climate, but also because of credit risk, we will face a risk in our portfolio. And that movement, I see it coming in more and more.
A follow-on question, sorry, Cass Sidorowicz from Georgeson. Follow-on question for Hans. So in terms of divestment, are you more in favor of engagement and selection in terms of portfolio creation rather than divestment?
Yes, well, depends what you look at. If you look at the fixed income portfolio, for an insurer that is easily 70-75%, because that's where we match pension liabilities. Let's not forget, we are still honoring today pension liabilities from customers that came in the 90s who gave guarantees of 4.5, 4.75%. And these have been matched by investments from that period. It would be dangerous for us to divest these bonds early, but keeping the liability, because we want to keep our commitment for the pensions of our customers. So for those companies, indeed, it is the solution. Let's engage with them. It will gradually go down because we will not add new brown or dark gray investments, so it will automatically go down, but not by divesting, but not by renewal investment. An equity portfolio, for instance, or a real estate portfolio is a little bit more liquid. A real estate portfolio, we have our own real estate, so there we can organize ourselves. That real estate becomes more greener. On the equity portfolio, yes, there we transact a lot more frequently, And there I would say we could greenify the portfolio a little bit further, but it is for us a balancing act between improving on the E and managing the S of the pensions.
You're very progressive in terms of your inclusion of the debt side of this equation. Too much of the discussion on ESG is focused on the equity. Just wondering if you have a thought on corporate issuances for the debt markets and how the buy side can put pressure on corporates to address some of these issues via debt.
Yeah. Well, you see the evolution of green bonds coming in, and I see it becoming more and more popular. Again, what I think is good that when regulation comes in, when we have healthy activism, when we have all the awareness, corporations will be forced, to add green elements to get their fundraising, to get the bond investors, or to keep the interest rate lower. Professor has already proven in earlier studies that you do pay an equity premium or you take a risk premium on your bond if you are not going on this road. And my call here is, and I see another question, if you do something, is the risk that it's not going somewhere else? To make the impact global, we need that regulation, we need that level playing field, and we need that standardization, because otherwise we can take those actions, but if my neighbor is not taking the same actions in their investment portfolio, we are not gonna move the needle. So regulation, I think, is too often still claimed like we need a regulation for corporate world to start moving. If I talk to Europe, and I talk mainly on Europe, I think when I talk to corporates, all the corporates are already on the movement. The only thing is we can accelerate the movement if we can do it in a proper framework, avoiding the risk of greenwashing, avoiding the risk of activism, because the definition, the taxonomy, the scope is not stable. And if we can stabilize that, I think we can accelerate the movement that already started. But I was very happy to see after summer that our investment analysts came back and say, look, we can already do 50% on the 100 billion portfolio by 2030. Honestly, for me, it was a positive surprise. I thought it would be longer.
I'm going to intersperse one question from Slido, and then Lady in Pink, please. Okay, so the question in Slido is one from Carol Lanu, that the best return this year was in carbon emitters. I think this one's for you, Patrick. As long as there is no penalty for brown investments, we are fighting against windmills. How to get there?
Yeah, so just to rephrase the question, the best returns this year was in carbon emitters, and as long as there is no penalty for brown investments, we are fighting against windmills. Okay, so yeah, this year returns on brown investments were great. Why? We have an energy crisis. Oil price shot up way above trend. We have the war in Russian invasion in Ukraine. Yeah, oil companies did very well. However, this is often not said. Oil companies did well, but what about airlines? What about all the companies that rely on oil? You know, think about households. You know, their heating bills over the winter, they're not doing great. They wish they were renewable. You know, that's the flip side. The other thing is that yeah, it's a shock. Before COVID, you know, from 2015 up to 2020, 2021, green was producing the higher returns. So that's a complicated thing. So you can't just make simple statements like that. And then final point, if you go sector by sector and you control for, you know, you look at you control for what companies do, you look at which companies stand out in terms of carbon emissions. Well, the ones that stand out in terms of carbon emissions have a lower valuation. That is a robust finding, and so they are penalized They're already penalized, but they're not penalized enough.
Thank you.
Thank you. Thank you all. I'm Angela from the Italian government. I have a question for Patrick. I would like to ask about this risk management. We all know that risk management lays on risk evaluations, which in its turn relies on information. How would you address the existing gap between the taxonomy and the CSRD, which are still under development, and the correct risk management?
Okay, I think if I may rephrase your question as I understood it, so risk management builds on information, and then we have different approaches, different things we measure, and how does that affect risk management, right? And then in particular with the green taxonomy. So I don't have a very well-informed perspective on this question. What I've heard, the best thing I've heard about your question in terms of response is, you know, many investors don't like green taxonomy. They think it's not helpful for their risk management. You know, many have said that. But what I've heard about the green taxonomy, which I think is a strong counter-argument, is that it wasn't designed to help investors' risk management. It was designed to channel investments to green investments. So that's a different objective. And if you look at that objective, it has been successful in channeling more investment to green investments. Maybe not so helpful for investors, but you know, that's a different matter.
Well, of course, investors often do not want to have too many rules and boundaries to invest. But I think today the major concern is about scope. The scope is so wide. And you see that also how the rating agencies deals with those scope. If you look at credit ratings, companies with different credit agencies are more or less always in the same bucket. They have different models, they have different interpretation, but the end result is very much the same. If I look at credit ratings of companies like ours, they all use the definition ESG rating, and in some of them we are top, and other ones we are completely at the bottom, and we are exactly the same company. So there I think we need some, I would say, to get it some cleaner. And there was, by the way, a good article in The Economist a few weeks ago on ESG, where they said, look, if we really want to facilitate the business world to make progress, let's maybe isolate the E. That was one of their suggestions, because if we do E, S, and G at the same time, it becomes too blurry. And in the world of today, with social media, with activism, with greenwashing, a company cannot make commitments in the future or make too much public statements if the definition around that is too blurry. And therefore my call to get some guidance, and I know Europe is working on that topic, and we hope, I truly hope that Europe can create some consensus in that respect. And believe me, we are in 9 countries in Asia. And when we did the whole ESG story, everybody just said, yeah, but for Asia, I'm sorry, let's take it for Europe. We feel safe, we can probably deliver. In Asia, there is no way we can deliver. After COVID, I was able to visit all our countries in Asia again in July. There was not one country, not one partnership we have in Asia, not asking us, where are we going, how do we define, and what can we learn from you, because we want to go on the same road. I even met the Thai ambassador, and the Thai ambassador told me, he said, look, as the Thai government, we are considering to subscribe to the European Green Deal. So that's these initiatives, and I think we see us, by the way, Europe, but also us as Ageas, as a European Asian country, we can play a role to spread the message, but we are limited. We need also supranational regulation and standardization, because that could facilitate it a lot faster. That's my view on the topic.
I think we have time for one more question. Yes, in the middle.
Thank you. Tobias Tröger, Safe and Good University, Frankfurt. So I have a question to Patrick. You're presenting an extremely elegant model of a of a strategy for net zero investment that it can operationalize. And isn't there a risk that this creates exactly the feel-good moment for some investors, but doesn't really capture the full picture? Because what we know is that a sustainable business strategy is much broader than just net zero carbon emissions focus. If we think about what economic activity negatively does to ecosystem services, land use and biodiversity loss are subjects, and some of the strategies that reduce carbon emissions are actually counterproductive for these goals. And my question is, presenting such a strategy that you do, doesn't that crowd out the efforts for a more holistic approach and developing metrics that are equally can be equally operationalized, but are just not there yet?
Thank you, Tobias. Before you answer that one, Patrick, I'll just take the final sweep-up question, and we'll take them together, because I think the gentleman behind also raised his hand.
Thank you. My name is Guy Jubb. I'm from the University of Edinburgh and also the ECGI. My question is to Hans. Hans, I am an accountant and I like accountability. In terms of making a difference in mitigating climate risk, particularly around the financial cost of carbon, one of the key rights of shareholders in most jurisdictions is to attend and speak at AGMs as part of the engagement process. And in my experience, boards of companies do not like it when actually investors, such as Ageas, stand up and make their point in that forum, and also have the benefit of addressing not just the chief executive and the IR person, but actually the board as a whole can get the message. My question is, to what extent does Ageas, in terms of the policies and the objectives which you have outlined, attend and speak at AGMs? And what is your policy, in part of your anticipating your response, what would be your policy on that as the years develop? Or is there a green ceiling to engagement?
Thank you. So 30 seconds each, please. Patrick and then Hans.
Okay, so in the interest of time, so you're right. An exclusive focus on carbon emissions may come at the expense of other desirable impact, environmental impact reductions. A very concrete example is biodiversity versus carbon reductions. And when it comes to carbon credits with forests, that's a very concrete trade-off. So you're absolutely right. The focus on carbon, that's been why I've focused so much on carbon, is to address the other concern we have with ESG, which is too multifaceted. What are the metrics? It's very confusing. How do you compare success of one metric next to another? That's why I like to focus on carbon. Carbon is also something you can measure, and it's the most important thing for climate change. So that would be my answer.
Well, on your question, Professor, we are very transparent, EGM. The commitments that I've given you on the screen are public. They are also on our website. All our investors can read them. They can comment on them. And in our EGM, we never shy away from anybody who stands up and poses us a question. So in that respect, we are very transparent. I do hope that I can avoid questions by also communicating a lot in the annual report and on the website before even the question comes in. Where we are careful, and that comes back to what I've said earlier, is in areas where you say you make a statement today, like 10 billion in green investments. That's today our definition, what we call a green investment. If tomorrow there comes a formal definition what you can call a green investment, I have no idea whether our portfolio falls from 10 billion to 6 billion or goes to 14 billion. Today I don't know. So we have to be careful there on our statements, because otherwise we could be blamed afterwards for misleading the market, miscommunication, and there is a whole legal network and activist network behind us. But we are open for any type of questions that comes in an EGM, and we will address them properly.
Thank you. So I will wrap up our discussion at this point. Thank you to our panelists. Thank you all. You have been an excellent and very engaged audience. And also for those of you who have been watching the digital session around Europe. I think I've heard three things from our conversation today. The first is that climate risk mitigation is about, and increasingly about, risk pricing. This is no longer the preserve of the environmentalists and the activists alone. It is about ESG investment as a mature and growing asset class. And so if already 40% of the market and growing is about ESG investments, then it's about asset pricing and mispricing, which is the preoccupation of the financial market participants. Second, this takes us to the preoccupation of financial economists and microeconomists. It is about market efficiency. So both Patrick and Hans have spoken about this being a market-led and investor-led shift in allocating capital towards decarbonization. And that at the same time, it cannot be government-less, that the regulators and policymakers need to do more, especially in the field of standardization and quality and embedding norms. It is then a priority to build the efficiency, liquidity, and depth of the benchmarks and the markets that will enable us to price the factors that contribute to climate risk, including carbon. So at the same time that this policy is playing a role in enhancing the efficiency of markets, it's also about easing the frictions that Hans talked about in terms of maintaining that just transition from a fossil-fueled economy to a green one. And that takes us to the third and perhaps the most congruent element of the theme of the day, which is the sustainability of the business models, that it's the commercial imperative for corporates to focus on sustainability and long-term value as part of all of this. So, pricing risk, market efficiency, sustainable business models. This takes us back to where we began in terms of the theme of responsible capitalism. Thank you all, and we'll now take about 15 minutes and come back for our next session on the role of regulation.